Nasdaq 100 futures are actually up 0.74% this morning, trading right near 29,690. And S&P futures are sitting up 0.34%, right around 75.50. But if you are an active trader looking at this pre-market action for Thursday, July 9th, 2026, you really should not take that green at face value.
Yeah, absolutely do not, because the institutional strategy notes we're diving into today, they are flagging a massive, just a bizarre contradiction right now. I mean, the broad market sentiment is technically categorized as neutral, but underneath that, it is incredibly fragile.
Right, we've got a huge tug-of-war happening. It's like a sports car trying to accelerate while the parking brake is just fully engaged.
Yeah.
You have the tech sector slamming the gas pedal, trying to pull the major indexes up, but global geopolitics is violently yanking that brake.
Exactly. And to figure out where the smart capital is actually flowing today, we really need to unpack what that parking brake is first. You know, that external macro pressure that's just dragging everything down in the overnight session.
Which is the overnight geopolitical shock. I mean, the intelligence briefings are confirming that the temporary U.S.-Iran ceasefire is it's completely dead at this point.
Yeah, it's gone. We are now seeing fresh military strikes and retaliatory actions, and the immediate tangible market impact of that is a severe disruption of commercial shipping right in the Strait of Hormuz.
And that's not just some isolated regional issue, right? The Strait of Hormuz is, well, it's one of the most critical arteries for global energy logistics.
Oh, without a doubt. If vessels cannot safely pass through that specific choke point, the entire global supply chain instantly tightens up. The physical supply of oil is effectively bottlenecked right now.
Which gives us an immediate energy shock. I'm looking at the morning data, and it shows Brent crude spiking towards $79 a barrel.
Yeah, and WTI crude is holding near $74. So as a direct consequence of that, you've got capital just flooding into the energy sector to hedge against this exact risk. Energy, specifically if you look at the XLE ETF, is the undeniable sector leader today.
Right, oil going up and pulling energy stocks up with it, I mean, that's a straightforward chain reaction. But it's the secondary ripple effect of that oil spike that seems to be really terrifying the broader market. Because higher energy costs, they bleed directly into the bond market.
They do, and the bond market reaction is where the actual systemic danger lies. The 10-year Treasury yield has spiked to 4.57% this morning.
Wow.
Yeah, it even brushed against 4.58% overnight. I mean, that is a 4-week high in general terms, but if you look at actual borrowing costs for corporations, it's a 7-week high.
So it's not just the absolute number, it's the momentum behind it.
Precisely. This marks a relentless 7-day rising streak. It is the most aggressive, sustained run of rising yields we have seen since late 2024.
And right alongside those surging yields, you have the U.S. dollar index. The DXY, which measures the dollar against that basket of foreign currencies, is holding incredibly firm, right around 100.96.
Yeah, it's acting like a wrecking ball.
So we have this scenario where borrowing costs are surging, the strong dollar is punishing foreign exchange, and basic energy inputs are just spiking. And all of this leads straight to the Federal Reserve's doorstep.
Oh, it's an absolute nightmare scenario for Fed Chairman Kevin Warsh and the FOMC today. I mean, the June meeting minutes already showed us a deeply divided committee on how to handle inflation.
Right.
Now, with this geopolitical energy shock restricting the oil supply, the market is suddenly waking up to the reality of sticky supply-driven inflation, that comfortable narrative everyone loved. You know, that inflation is dead, that has been completely shattered overnight.
Because higher oil prices just mean higher transportation costs.
Yeah.
Which means higher prices for, well, literally every physical good that gets put on a truck. But wait, let's unpack that logic for a second. If inflation is rising because physical ships cannot get through a geopolitical choke point, the Fed raising interest rates doesn't clear that straight. I mean, the Federal Reserve cannot print oil. Aren't they just going to crush the consumer to try and fix a physical supply problem that they have absolutely zero control over?
Yeah, you hit the nail on the head. That is the brutal reality of what the institutional strategists are calling a supply-side trap this morning. The Fed knows perfectly well that raising rates doesn't put a single extra barrel of oil on the global market.
Right, so why do it?
Because inflation operates like a psychological contagion. If the cost of goods keeps rising due to energy inputs, consumers and businesses start expecting prices to just rise forever, which changes their spending behavior entirely.
So the Fed's only tool is to just destroy the demand side of the equation.
Exactly. They have to keep rates higher for longer to make borrowing so insanely expensive that businesses stop expanding and consumers just stop spending. It suppresses overall demand so that prices stop spiraling.
But the tragedy there is that it brutally squeezes corporate profit margins and completely drains consumer wallets.
Yeah, high rates won't fix the shipping lanes, but they guarantee that the cost of capital remains toxic for the broader economy. And get this, futures markets are now pricing in a greater than 50% chance of a rate hike in September.
A hike, not a cut.
A hike.
Wow, that is a massive paradigm shift from just a few weeks ago.
Mm.
Which brings us back to that sports car analogy. The macro picture, the oil shock, the rising yields, the hawkish Fed that is the parking brake.
Right.
But despite this incredibly hostile macro environment, somebody is still out there slamming on the gas pedal.
Mm.
Like we said at the open, Nasdaq 100 futures, the NQ, they are actually up 0.74% right now.
Yeah.
Tech is just blatantly defying the macro data.
And that resilience in the pre-market tech sector is driven by a very specific microcatalyst. Overnight reports are indicating that Beijing is going to allow top Chinese AI firms to purchase a limited supply of NVIDIA's H200 chips.
So despite all the broader geopolitical tension and the export controls we've been tracking, the flow of highly lucrative AI hardware isn't completely frozen.
No, it's not. And that provides a massive sigh of relief for the major chip makers. It triggers an immediate reflex in the market. Traders see the NVIDIA news, they see the green in the pre-market Nasdaq futures, and they just start piling back into these massive tech stocks.
But the institutional sources we are analyzing today are flashing some severe warning signs about this specific behavior. They are labeling this tech bounce a liquidity trap.
Yeah, that's the exact phrase they're using.
It seems like retail investors are acting like passengers boarding a sinking ship just because they got a discount on first-class tickets. I mean, the tech narrative looks great on the surface, but the macro hull of the ship is completely breached by those rising bond yields.
That captures the danger perfectly. Retail investors are buying into this tech rally, operating under this deeply flawed assumption that a Fed pivot to lower rates is still on the table.
Even though a rate hike is now statistically more likely?
Exactly. And this miscalculation leads to a dynamic the briefings call an equity risk premium collapse.
Okay, so if you are listening to this and holding a heavily tech-weighted portfolio right now, how does an equity risk premium collapse actually threaten your capital? Walk us through the math of why these institutions are so alarmed.
Sure. So when you invest in the stock market, you are taking on inherent volatility and risk, right? To justify taking that risk, you demand a premium, a higher potential return compared to just holding a safe asset.
Makes sense.
But when the 10-year Treasury yield spikes above 4.5%, the U.S. government is essentially offering you a guaranteed risk-free return of roughly 4.5% on your cash.
Right.
As that risk-free rate climbs, the premium you get for exposing your money to the stock market shrinks rapidly.
And eventually that premium just collapses. I mean, why risk your capital in a volatile tech stock trying to squeeze out a 6% return when you can just sit on a guaranteed 4.5% with zero stress?
Exactly. That shifting math puts a hard ceiling on how high-tech valuations can expand. Furthermore, these mega-cap tech giants are multinational corporations. We noted earlier that the U.S. dollar index is holding near 101.
Yeah, the DXY.
Right, and a strong dollar means that when these tech companies sell software or hardware in Europe or Asia, those foreign revenues translate to far fewer U.S. dollars when they are brought back to the balance sheet.
So tech companies are getting squeezed from both sides. You have bond yields capping their valuations on one side and currency exchange rates eroding their actual revenue on the other.
Which is why chasing this morning's tech breakout is a highly, highly dangerous game. The institutional briefings actually provide very specific daily lines in the sand to map out this risk.
Okay, what are the levels? Let's get into the data.
For S&P futures, which are currently trading up slightly near 75.50, the critical support zone, the floor that separates a manageable dip from a cascading sell-off, is right between 74.85 and 74.95.
And what about the Nasdaq?
For the Nasdaq, that trapdoor is at 29,540. If the market drops below those levels, the liquidity trap springs shut.
Okay, so if chasing the green momentum is a trap for retail traders, what is the actual mechanism the institutions are using today? Where are they deploying capital?
The institutional strategy in this specific environment is pure mean reversion. They are completely ignoring these momentum breakouts. Instead, they are waiting for the market to hit 2 sigma levels.
2 sigma, so 2 standard deviations from the mean.
Exactly. These are the rare, extreme statistical outliers where the mathematical probability of a snapback to the average is incredibly high. So if the S&P pushes up to extreme, unjustified resistance at 76.54, institutions will actively bet against it.
And if it flushes down to extreme support.
If it flushes down to 73.77, they will buy the panic. They are systematically playing the boundaries of the volatility, not the direction of the trend.
Okay, so we had this high-level tug-of-war established. The macro shock of oil and a hawkish Fed pulling down against the micro relief of tech and AI pulling up. Let's ground these massive forces into some actionable company-specific examples.
Let's do it.
How are these dynamics physically altering the valuations of individual stocks today? Let's start with the clearest reflection of that geopolitical shock. Occidental Petroleum, ticker OXY.
Yeah, Occidental is functioning as the ultimate high beta play on crude oil this morning. In financial terms, a high beta stock moves faster and with more amplified volatility than the broader market or its underlying commodity.
Right, it's hypersensitive.
Exactly. And what stands out in the pre-market is that OXY is significantly outperforming massive stable oil majors like Chevron and Exxon.
Well, it can't just be riding the rising tide of $79 Brent crude, right? There has to be a structural reason they're outperforming their direct peers.
There is. The outperformance is driven by a massive double upgrade from the research firm Evercore ISI, moving OXY's rating all the way to outperform.
Oh, wow, a double upgrade. What's the thesis?
Evercore's thesis focuses on OXY's aggressive corporate balance sheet mechanics. You see, following their massive acquisition of Crown Rock, OXY accumulated a significant amount of debt. But they recently executed a $9.7 billion sale of chemical assets to Warren Buffett's Berkshire Hathaway.
So injecting nearly $10 billion in cash directly into their balance sheet. And in a macro environment where the 10-year yield is spiking to 4.57%, paying down existing debt quickly is absolutely crucial.
It's everything.
I mean, if they had to refinance that debt in today's high-rate environment, the interest payments would just cannibalize their profits.
And that is the exact mechanism being rewarded by the market today. The cash injection allows them to deleverage rapidly, shielding them from the toxic bond yields we discussed earlier. Furthermore, they are projecting a restart of aggressive share buybacks by the second half of 2028.
So what's the target Evercore is slapping on this?
Evercore's bull price target for OXY is now $65. However, the macro risk remains. Their bear target is $51.68.
It's quite a spread.
Yeah, because if the tensions in the Strait of Hormuz suddenly cool off, OXY loses that geopolitical premium instantly and will quickly retest that lower support level.
Right, it's a double-edged sword. Let's shift gears from energy supply to the consumer demand side. We have PepsiCo, ticker PEP, reporting today. And this acts as a real-time health check for the average consumer who is, just trying to survive the inflation that rising oil prices create.
Yeah, PepsiCo's Q2 earnings report this morning provides a very nuanced look at the consumer wallet. They actually missed earnings per share estimates by a single penny, reporting $2.20 against an expected $2.21.
Okay, so a tiny miss on the bottom line.
But they slightly beat their overall revenue expectations, hitting $24.18 billion.
Well, 1 penny miss on the bottom line with a slight beat on the top line. I mean, that seems like a wash on the surface. But the market response is going to hinge on the underlying mechanics of how they actually achieved that revenue, right? Specifically looking at Frito-Lay North America.
You're exactly right. Wall Street is laser-focused on the Frito-Lay division because PepsiCo was forced to enact aggressive price cuts up to 15% on certain items earlier this year.
Because consumers simply hit a breaking point and stopped buying premium-priced snacks.
Exactly. So the analytical question today is whether those price cuts actually drove a recovery in sales volume.
Essentially, if a bag of chips is 15% cheaper, did the consumer buy enough extra bags to make up for the last profit margin per item?
Yes, that is the volume recovery metric everyone is watching. They are also scrutinizing PepsiCo's ability to expand their profit margins following a massive $4 billion settlement with the activist investment firm Elliott Management.
So if they pull this off, what are the targets?
If PepsiCo can prove that their turnaround strategy is driving volume without sacrificing too much margin, the bull target sits between $164 and $167.
But if the volume data suggests that consumers are still pulling back, even with the price cuts,
then it signals that the consumer is structurally cracking under the weight of sustained inflation. In that scenario, the bear target is $132.96, which brings them right back down to their 52-week low.
Which is a huge drop. Okay, moving from the consumer crunch to the center of the tech bounce, we have NVIDIA, ticker NVDA. They rebounded strongly in the previous session, climbing 3.69% to close at $204.20.
And that rebound is really notable because it required NVIDIA to actively squash a growing narrative that their product pipeline was faltering.
What was the rumor?
A research firm called Semi-Analysis circulated a rumor that NVIDIA's next-generation Kyber NVL144 AI system was facing severe manufacturing bottlenecks and would be delayed until 2028.
Oh man, in a market environment this fragile, a rumor about a multi-year delay for a flagship product could have triggered a massive sell-off.
Oh, absolutely. But NVIDIA recognized the danger and aggressively refuted the report, confirming to the market that their production timeline remains fully intact. And Wall Street institutions are aggressively backing NVIDIA's narrative today.
What are they saying?
Bank of America reiterated a firm buy rating this morning, framing this recent multi-month dip as an enhanced entry point for institutional capital.
And what's their target?
Bank of America's bull target is sitting at an aggressive $300. They are clearly betting that NVIDIA's pricing power, their ability to charge premium rates because their hardware is essentially a monopoly, will just outrun the macroeconomic headwinds.
But again, the gravity of the bond market is waiting in the wings.
Always. If yields keep rising and choke off corporate spending, NVIDIA's bear target is $200. A break below that psychological level signals a much deeper structural correction for the entire tech sector.
Okay, so we've tracked OXY capitalizing on geopolitics, Pepsi navigating a squeezed consumer, and NVIDIA trying to outrun bond yields through sheer pricing power. But when you look at the broader institutional briefs, there is this fascinating contradiction in how the market is choosing to punish or reward companies today. And the divergence between Levi Strauss, ticker LEVI, and AZZ Inc. highlights this perfectly.
It really does. The price action between those two companies exposes exactly how ruthless and specific institutional capital has become in this high-yield environment. So, Levi Strauss released a genuinely robust quarterly print. They beat earnings per share estimates by a very healthy 28 cents.
Which is great.
Yeah, and they went a step further by officially upgrading their full-year guidance.
A massive EPS beat coupled with raised guidance. That is traditionally the absolute strongest signal a company can send. Yet despite delivering the textbook perfect quarter, Levi stock plunged 5% in late trading. And on the complete opposite end of the spectrum, you have AZZ Inc., a business focused on industrial infrastructure and metal coatings. They beat their EPS estimates by 16 cents, reporting $1.85 against a $1.69 expectation, and their stock surged pre-market.
It's wild.
Why does Levi get punished for a massive beat, while AZZ gets rewarded for a smaller one?
It reveals the underlying logic of a market operating under the threat of a liquidity trap. In a stable economy, a backward-looking earnings beat is rewarded. But in a fragile 4.5% yield environment, institutional investors do not care what you achieved last quarter. They only care about the mechanics of your forward-looking visibility.
So it completely comes down to the certainty of their future revenue streams.
Precisely. Levi Strauss relies entirely on the discretionary income of the everyday consumer. Even though they had a great quarter, the market is looking at $79 oil, rising inflation, and the prospect of a Fed rate hike, and concluding that the consumer who buys those jeans will not be able to sustain that spending going forward.
So Levi's future revenue is highly vulnerable.
Exactly. Whereas an industrial company like AZZ operates on a completely different timeline. Their revenue isn't dependent on a consumer walking into a mall today. They secure massive, multi-year infrastructure contracts, often tied to long-term government or corporate capital expenditure.
And that long-term contract structure insulates AZZ from the day-to-day volatility of the consumer wallet. They possess tangible, forward-looking visibility.
You got it. In this specific macro environment, a predictable, insulated margin, even a smaller one, is infinitely more valuable to institutional capital than a massive but vulnerable retail beat.
Synthesizing all of these moving parts brings us back to the core tension-defining Thursday morning, July 9th, 2026. We are witnessing a profoundly dangerous tug-of-war. You've got the micro-level tech relief rally, led by NVIDIA holding the line in news of Chinese AI purchases, trying desperately to pull the indexes higher.
But that effort is swimming upstream against an overwhelming macroeconomic current. A geopolitical supply shock in the Strait of Hormuz is driving crude prices higher. That energy spike guarantees sticky inflation, forcing a deeply divided Fed to keep the cost of borrowing toxic. And hovering above it all is the 10-year Treasury yield sitting at 4.57%, just actively suffocating the equity risk premium.
So if you are listening to this and managing your own portfolio today, what is the definitive, actionable takeaway from these institutional strategy setups? How do you practically navigate a market that is fundamentally pulling itself apart?
The consensus across the institutional desks is defensive discipline. First, do not chase the pre-market green momentum in tech that is the bait for the liquidity trap.
Don't fall for it.
Right. Second, keep your position sizes remarkably small until the broader geopolitical picture stabilizes. You must fixate on the bond yields. As long as the 10-year Treasury remains above that 4.5% threshold, any rally in risk assets is built on a very fragile foundation.
If capital isn't safe chasing breakouts, where are the institutions parking their money to wait this out?
They are actively locking in the guaranteed high yields available on the short end of the Treasury curve, and they are intentionally holding a significant cash buffer. When a market is experiencing this level of internal contradiction, liquidity and patience become your most aggressive assets.
It all comes back to respecting that parking brake. We started by comparing the market to a sports car trying to accelerate with the brake engaged. But looking at the sheer disruptive power of this morning's military escalation, it leaves you with a deeply unsettling realization about how fragile our financial architecture really is.
How do you mean?
Well, we spend so much time analyzing corporate mechanics, earnings per share, profit margins, AI product cycles. But today, a highly anticipated multi-billion-dollar tap rally is being entirely derailed by a single geopolitical event, half a world away in the Strait of Hormuz. It forces you to wonder if we are entering an era where a company's internal fundamentals matter far less than its geography and its exposure to global supply chains. Next time you review the companies in your portfolio, ask yourself, how much of your wealth is quietly relying on the assumption of perfect global peace?